everyone. So sorry for the delay today. Thank you for joining me on this Facebook Live. Let me just wait a few minutes since I had some technical issues and I'm trying to streamline everything now. Awesome. Okay. All right. So thank you. So thanks for joining me today on this session. My name is Catherine Agapchan, and I run Sisters for Financial Independence, where we help you manage your money better so you can live a life of impact today and tomorrow. Our goal at Sisters for Fi is to educate and provide a learning and community platform for you to grow your money so you can do good with it. Today, I will be covering the basics of investing so that you can make your money multiply for you and your family. Stay tuned because at the end of this video, I will also share a few tips for you to get started, whether you're starting with $10 or $1,000 for investing for yourself or for the future generation of your family. I'd also appreciate if you're watching this to give it a like if you love the content, or a comment if you want me to expand on a particular topic. My goal here is to educate, provide you all the options that's available to grow wealth and make sure you have financial security today and tomorrow. So, what exactly is investing? You probably heard the word thrown around. You may already be investing, and this is just maybe another lesson for you to kind of get to know what investing is. So the standard definition of investing is putting money, time, and effort into something with the expectation that will return a benefit in the future. So there's a lot of areas where you can invest in. You can invest in yourself, maybe by reading a few more books, taking a course, hiring a coach. You can invest in your education, in your knowledge. You can invest your money so that it grows over time. And what will happen is that once you invest your money starts making money. That's when money starts multiplying. And really that's the goal of investing in today's age. It's because we have a finite amount of days and working hours and really working energy, right? So we can't continue to work and make money, especially as we get older, or especially at some point when perhaps we no longer want to do what we want to do, or we want to pivot to another career. And money can help you kind of pause, reflect, reset, or realign. And money that's invested can grow faster than you saving it in a traditional savings account, or you just holding on to cash, right? Saving is a great option for you if you have short-term needs where you need to access that cash within a few years. And what's the difference between saving and investing? Well, saving money is just having that money ready for access. Investing is all about long-term thinking, right? So 10 years, 15 years, 20 years down the line when you need to access that money. The reality is that if you save your money in like a traditional savings account versus invested, in this case in the stock market, you actually lose out money if you just put it in the savings account. The challenge is that savings account don't pay you. They may pay you 2% or less in most cases. And what happens is that over time, inflation starts eating up your savings. So by the time 20 years down the line, the money you saved might not be enough to pay for whatever your expenses are. Whereas savings grows, whereas investing can grow a little bit more depending on what you invest in and how long you keep that money invested. So think of investing as a way to really multiply your money faster for the long term. Now, there's going to be a few questions when we talk about investing. The first question that you're going to ask yourself is, why do you want to invest? This is the big question. What are you saving up for? And some of these are big things. Maybe you're saving for, or you're investing for your retirement, which could be a long way from now, but you want to invest for that. You could be investing for your children's education. You could be investing for a way to get out of the current job that you have, so you want to shore up a bunch of money for your nest egg. So think of that. Think of what you're investing for. Think big when it comes to that, so you have an idea of why you're investing. And the why is really important because it helps kind of focus you on where you want to put your money. Second question you want to ask yourself is, how much money right now do you have to start investing? And many folks will come in and say, I don't have much. But I want you to quantify that. Find a number that you can put aside to invest. This is money that you're not going to need within the next few months and few years. You're going to put this money away. You're not going to see it for a few years. So think of that. If that number is small, that's okay. What we're going to do is start increasing that, maybe year over year by 1%, 2%. Just focus on what you can do now. And you might kind of come to me and say, I don't have any money to invest. So I'll point you to the budgeting video that I did a few weeks ago to really figure out, hone out where you can cut expenses so that you can put more money saving towards you and investing for yourself and your future. The third option is your time horizon. So depending again on your goals, what is the time horizon where you want to access these investments? If you're saving for retirement and you're thinking, I'm going to be retired at the age of 65, how long is that from now? If you're 30, you have some time. If you're 50, you don't have a lot of time, but yet you can still use the power of time to get you to getting that investment kind of growing over time. Long term is best, so maybe 8 years or over is the best place. It's kind of a best time horizon for you to do that. So start early, start today if you, to get the investment started and compounding over time. What's your risk tolerance? So we talk about risk in investing because if you put your money in the stock market and you watch it day to day, you're gonna find that a lot of your emotions will kind of come to the surface, right? So when you hear news of the stock market going down or the points going down, not going up, you might panic and you might think, oh, it's time for me to get out of the stock market. This is crazy. And this is where some of your risk kind of comes in because there's risk inherent to anything that you invest in, whether you invest in the stock market, in a business, in yourself, because there's the expected, you have expectations, right? So when you do that, figure out your risk tolerance. Again, if you're doing a long-term investing, you can probably stomach a few years of down because over time, and research has shown that the stock market and your investments, if invested properly, go up over time. So keep that in mind as you work through kind of your risk, you'll understand your risk tolerance and investments. So when you invest, there are a few areas that you're going to look at. One is when you need to access that money, and that is going to be critical because there are many accounts out there that provide you tax advantage where you can defer payment of taxes to the future, and that allows you to reduce your taxable income today, but it will tax you when you withdraw the money. Most employer-sponsored accounts have the option for tax deferment or pre-tax. And if you already contribute to your employer-sponsored retirement account, you are already investing. But that's only just a vehicle, right? Just a vehicle for you to do that. The other option is a taxable brokerage. This is where you would invest in an account where you'll get taxed on it once you sell those assets. And with a taxable brokerage, there's more options for you to do that. You can sell those assets. You do get taxed, but there's no age limitation. You can sell it whenever you want. You can access that money whenever you want. With some of the tax advantage accounts, like your employer-sponsored accounts, that money must sit there for a period of time or until you're 70 and a half or 59 and a half in order for you to access it without penalty. So think of that when you are looking for investments. And yes, you can do both of those options, having a tax advantage account and a taxable brokerage account. So if you need to access something sooner, you can access the taxable brokerage. So how do you make money off of investing? Well, there's two ways. One is through capital gains. This is where the value of your asset, whether it's a stock or a mutual fund or ETF, increases in price, right? So say you buy an asset for $100 today, and 2 years from now, it's rose to $120. So that $20 is your gain. Conversely, you can also lose money, but all of this is also what's called unrealized gain or loss. So you don't necessarily lose that money or gain that money until you sell that asset. So if 2 years down the line you sell it at 120, that's your gain. You gain $20 and you've made $20 off of your investment. You can also make money through dividends, and dividends is basically when companies redistribute profits back to their shareholders. So if a company is doing really well and they have a dividend plan, what they'll do is issue you a dividend for each of a share that you hold within that company. So it could be as little as 25 cents, but if you own a large number of shares, that can add up. And there's option two is that whether you can take out the dividend to use for yourself to pay for current needs, or you can reinvest it, and that's where it buys more shares for you, so you can keep growing your investment account over time. And that's the beauty of the investing. It's like if you don't touch the money, it keeps growing, it continues to grow over time. There's three areas that you're going to invest to. You can either invest in a stock, a mutual fund, or an ETF. An ETF and a mutual fund are very similar in the way that they're structured. And I mentioned before that it's important for you to understand like what your risk tolerance is. Well, a mutual fund and an ETF provides you a diversified basket of investments. So think of a basket, and in that basket are different stocks, right? So this is like the egg in a basket. You have one basket, it's one mutual fund, and in that mutual fund you might have like a stock of one company, another company in the pharma area, maybe an oil company, a company in the computer division, and you have a diversified set of stocks in that mutual fund or ETF. Now, a mutual fund normally is managed by a manager, so some of them will have fees attached to it. Some of them will also change structure over time depending on what the goal of that mutual fund is. Mutual funds also have a minimum buy-in, so you must have like a certain amount of money to buy that fund, whereas the ETF, most of them are passively managed, so the expense fees are a little bit lower, and what will happen is that these are just what you can do is buy the ETF during any time during the day, and you get whatever price it's trading at. Whereas a mutual fund, you will have to buy it at the close at the end of the day, and you'll get the price at the end of the day. So very similar in the way that they're structured, just minor differences in at what point the price that you pay and when you do that. Conversely, you can also invest in stocks. And so whereas mutual fund ETF have different companies and stocks, you can also just extract the stock and buy that stock, right? So this is important if you find that a company, something that you're using and the company you love, and you want to kind of support that company, but also want to be able to take in, enjoy the profits of that company, you can also tap into that stock and buy it. And there's many options for you to start investing. We've talked about the employer sponsored retirement accounts. So if you have that, continue doing that. I'm also going to recommend maybe going with a taxable brokerage account, opening one up. There's many platforms that you can use for this. You can use the tried and true companies like Fidelity and Vanguard. And Charles Schwab. They are one of the top companies, platforms that you can invest in, and they have their own like funds that you can invest in as well. You can choose a robo advisor like Robinhood, M1 Finance, Betterment, Wealth Simple. What they'll do is ask you questions about like your time horizon, your risk tolerance, and any other questions that what they'll do is their algorithm, their code will determine what they'll invest in for you depending on what your needs are and your risk tolerance are. So that's another way to do it as well. So there's a lot of options there for you. What I will do, let's see if I can share a screen here. All right, so I was hoping to be able to do a screen share for you today, but I don't think I'll be able to do that. So the one thing that I would recommend is start thinking about the things that you want to invest in. One of these might be starting with companies that you use. It could be Starbucks, it could be Apple, it could be just things around your house, and see if the company that makes that is publicly traded. And if that's the case, see if that's a company that you want to invest in. Is it something? Do you want to participate in that company's growth, in that company's mission, and want to be able to profit from it? This is a big thing. This requires a little bit of a shift in how you consume. It's all about going towards like becoming less of a consumer and more of an owner. So thinking ahead of like what can you invest in so that you can grow your money over time. The other option too is those mutual funds that I talked about. There are a ton of mutual funds out there. You can look for the one that has a low expense ratios. Look for ones that have a wide range of stocks that you want to invest in, so that you have again a diversified set of investments. If you are starting very beginning in your investment or even in your career, I also encourage you to open up a Roth IRA. And a Roth IRA is an awesome savings vehicle, especially if you don't make a lot of money now. It also is a great way to build assets for yourself down the line. And basically it's another savings vehicle. So you have a Roth IRA, and inside that Roth IRA is the things that you want to invest in. Like mutual funds, stocks, whatever. And what this allows you to do is actually it allows you to grow your money over time, and you can access that money later on at around 59 and a half, tax free, and it just grows tax free. The caveat to that is that you put in after tax money to invest in that particular fund. It's a great way if you have teens that are earning income, that are maybe working a part-time job and they're getting a W-2. A Roth IRA is a great start for them, where they can start saving up for whatever they need down the line. And again, this is long-term thinking. So if you have a teen working a part-time job and you want them to save and also invest, that's a great way for them. If you are at home, if your spouse is working but you're at home taking care of children, opening up a Roth IRA, a spousal Roth IRA, can also be a great way for you to save if you're not earning income. And you can also look at our retirement savings options video for that to learn more about that. And future too, like think about like why are you saving for, and how can you participate in this ownership, in this equity ownership of the stock market. And there's a lot of options for you to do that. So if there's any questions, feel free to let me know. So that's the basics of investing. It doesn't have you don't have to make it complicated. There's also a lot of things that some things sometimes when you watch the news, they can make investing kind of scary and fearful. And I think sometimes if you turn off the news and just really focus on the fact that you have a game plan for why you're investing, what your time horizon is, what your risk tolerance is, and what types of investments you have, waiting for a few years to let your money grow, let it multiply over time, and you'll have a nest egg from there. So next week, I will probably do a more in-depth analysis of some investing options, mutual funds, stocks, and our ETFs. So we have a comparison of what these look like and how you'll be able to purchase them. All right. So I appreciate you tuning in today. If there was something that you learned today, let me know in the comments or give it a like, and hope to see you next week.